Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. If you are new here, make sure to hit that subscribe button because I'll be here helping you navigate through this crazy market every step of the way. Now, this video is going to focus on this very special ratio. That's the NASDAQ 100 divided by the S&P 500. We talked about this in the last episode. We got a lot of great feedback, but a lot of you wanted us to talk about the potential for a Wyckoff distribution pattern here that's forming on this chart that would correspond to a long-term top and significantly more downside on this ratio. Now, this is something I'm sure many of you heard occurred on Bitcoin very recently with a very similar type of pattern that ended up leading to a rapid 30 to 40% drop on Bitcoin. So that was a very violent move down. And this is potentially something that we're seeing right now on this ratio. We spent the weekend taking a look at these charts. And before I get into the details, I just want to say the similarities between the price action we have on this ratio and the typical Wyckoff distribution event pattern are striking. Now, this is why I love making these videos and part of our research available for free online so that we can have these types of discussions. We can have this type of feedback on our content, discuss new ideas, and get down to the truth, because at the end of the day, that is what is going to make us profitable. We are, after all, a retail investment community, and the objective is to help each other be profitable in the markets. So make sure to subscribe to the channel and smash the like button. And now, without further ado, let's get right into it. Now let's do a quick overview of what the Wyckoff distribution is and why it works. And before we actually take a look at this chart, we have to look at how large trends form. And so this is a very simple diagram that illustrates that you've got innovators and early adopters that come in at the very beginning of a move up before we begin to see prices rise. This is institutional money. Very large players coming into an asset, coming into a stock or a sector when it's overvalued before the hype starts to come in. And they take supply away from circulation. So they buy up all the shares and they hold them. And that creates a shortage of supply. And that's what sets up the entire environment for everything that's about to come next, where each slight increase in demand because of that shortage of supply creates large moves up in price. And so when you've got the rest of the market coming into that sector, so the early majority and the late majority, that's when you really get that bull market. But once price gets to a certain level, the smart money wants to book profits. They want to get out of the trade. Now, they can't just wake up one day and hit the sell button and unload all their shares into the markets, because that's going to crash the sector. So they have to do it very carefully. And that's typically when bullish sentiment has peaked. So when you've got bullish news headlines, optimism about price increasing, that's when the smart money can sell their shares to weaker hands. So the late majority that's being attracted by the hype around that sector. And that's where Wyckoff distribution events come in. These occur not necessarily for manipulation, but so that these huge pools of capital can get out of that asset very slowly and stealthily. Now, before we get into the specific characteristics of Wyckoff distribution events, I want to first talk about this ratio, do a quick recap, and what's the story behind where we currently are. So let's zoom out on this chart just so that you can get an idea of where we are. This chart goes back to the 1990s. You've got the dot-com bubble right here with a huge outperformance in the NASDAQ to the S&P 500. Then you had the dot-com bust, came back down to reasonable levels, and you then had the beginning of what was a 20-year outperformance of the tech sector relative to the broad market. And throughout the majority of those 20 years, we were trading within this price channel, very well defined, many reactions along the way, both at the bottom as support and at the top as resistance. And then you can see what happened right here in January, February 2020, right at the start of the pandemic. And let's zoom in here on a daily chart. And you can see on this chart this huge melt up in this ratio during the pandemic, where tech significantly outperformed the rest of the market leading up into summer of 2020. And this is actually where COVID puts us at a huge advantage, because we know that large institutions were caught off guard by the virus. They did not see it coming before the majority. And so we know that smart money went into the tech sector big time at that precise moment. In this move right here, you had a surge in volume and a huge rise in price. And that type of combination, rise in volume, rise in price, that corresponds to demand. So you had a tremendous amount of capital come into the NASDAQ 100 at that particular moment. And they did that to protect themselves from the pandemic, because the only real certainty in that environment during the pandemic, with all the different types of information that was flowing around, the only certainty was that tech was going to outperform the S&P 500. And so that's where big money came in. That's where the smart money went. So what happened after that? And the answer is very simple. Tech continued outperforming leading up into July and August, and these large institutions were left with extremely overweight technology portfolios. These huge institutions whose business models are based on diversification, all of a sudden were not diversified at all. Following a pandemic, they were way overweight on the tech sector. And something else that happened is that you had huge bullish sentiment from the retail community around that time. You had Apple going parabolic, you had Amazon going parabolic, and all the retail investors that got in during the pandemic that only saw tech outperform throughout that time were extremely bullish at that moment. So that creates the perfect environment for a Wyckoff distribution event, and the perfect environment for those large institutions to sell their tech portfolios to weaker hands. Now that's why it's very important to try and not participate in hype. We were never looking to get in on the tech hype. At that moment in 2020, we were looking at Bitcoin that was trading at around $10,000. So if you're new to investing and you want to learn the right mindset to approach investing and trading in general, don't hesitate to check out our website at gameoftrades.net. We provide premium analysis, premium research on any opportunity we see in the markets, whether that's short term in terms of trading. We discuss precious metals, cryptocurrencies, the stock market, specific stocks, and in terms of investing. So also based on fundamental cases for long-term opportunities in the markets. So back to the Wyckoff distribution. Does this actually respect the Wyckoff distribution characteristics? And we can take a look at this template we have here. And I'm going to highlight some of the key points of the Wyckoff events. And that is the buying climax right here. Then you've got an automatic reaction because of that overbought reading. And then a first show of weakness right here. And that's what determines the trading range throughout the Wyckoff distribution, between the buying climax and the show of weakness. And after that, you've got what's called phase B. And this is what is typical of Wyckoff distribution as opposed to accumulation, right? Because that's what we want to know. Is this a topping pattern, or is this a reaccumulation and continuation pattern? And phase B is where you can actually go above the range, and you tend to have very volatile price action, unpredictable moves, just a very difficult type of area to trade. You then have one last up thrust before eventually beginning that downtrend, breaking down below that support, back testing, and rejecting. And that's where you have phase E with significant downside. So we can take a look at what that looks like on the ratio. We have a huge move up here with a buying climax, automatic reaction, quick move down in response to that overbought reading. Then you've got that first show of weakness here, where you had that significant low. And you can see these two levels here are what make up the bottom of that range. And after that, you've got phase B. So this is phase B, where you've got a higher high and then very unpredictable type of price action. Very difficult to trade. And if you were trying to trade the FANG stocks in this area, you most likely got stopped out whipsawed on your trades. It's just very, very difficult. Then you've got one last up thrust where you take out the previous high, and then you've got the distribution. So from a technical standpoint, it looks a lot like Wyckoff. What we also noticed is the change in character in the volume. So while we said that rise in volume with rise in price corresponds to demand, right? This is very bullish type of price action. Well, the price action we have here is a lot weaker. We've got moves down in price accompanied with surge in volume. This is indicative of supply. And so that's another big characteristic of the Wyckoff distribution event. It's the switch from a demand intensive environment to an environment with excess supply, which ultimately eventually creates the sell-off. So evidence of distribution on the NASDAQ 100 is indisputable. We've definitely got price action that's a lot weaker and so far is not showing signs of recovery. Now we were looking at this bullish falling wedge, and this is a typical continuation pattern, but this hasn't broken out yet. So while if we get this type of move here and a big breakout, we get back above that line of support, we backtest it successfully, and then we resume off of it, that would significantly improve the structure and we'd be bullish on tech again. But that breakout hasn't occurred yet. We're still below that line of resistance. We're still in a short-term downtrend. And if we get a big rejection off this level here, we could see a lot more downside on this tech to S&P 500 ratio. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to drop a like and subscribe to the channel if you haven't already. In the meantime, good luck on your trading and see you next time.